So one of the biggest names in the Indian investing scene is finally going public. And you know what that means? The big question on everyone's mind is all about the Groww IPO. Today, let's break down the bull and the bear cases to help you get a real handle on what's going on. Let's just cut right to the chase, shall we? This is the one question every single investor is asking right now. Should you apply for the Groww IPO, or is this something you should just watch from the sidelines? Well, let's dig in. Okay, so first things first, before we get into the pros and cons, let's make sure we're all on the same page with the basic details of this offer. All right, here are the key numbers you gotta know. The total IPO size is a massive 6,600 crore rupees. It's going to be open for you to subscribe from November 4th to the 7th, and the price band is set between 95 and 100 rupees for each share. First up, let's look at the bright side, the bull case. This is the incredible growth story that has so many people excited. And wow, just look at this slide. The revenue numbers are pretty staggering. In fiscal year 23, we're talking about 161 crore. But just 1 year later in FY24, it absolutely skyrocketed to 462 crore. That's almost a 3x jump in just 12 months. Now, this is where the story gets really interesting. It's their financial turnaround. See, in FY23, they actually posted an 85 crore loss, which they said was because of some one-time costs. But by FY24, they completely flipped the script, wiped out that loss, and became a profitable company. That's a huge deal. And here's the kicker. It's not just that they're profitable, it's how profitable they are. An EBITDA margin of over 59% is just incredibly strong. It shows that the business isn't just growing, it's growing in a really, really efficient way. That's a major point for the bulls. Okay, so what about the price tag? Let's be honest, the valuation is definitely on the high side. It's at a premium. But the people who are bullish on this argue that it's totally justified. I mean, when you factor in their crazy growth, their position as a market leader, and you stack them up against competitors like Angel One, they say that premium makes perfect sense. But, every story has two sides. So now, let's flip the coin and talk about the bear case. These are the reasons you might want to tap the brakes. Yeah, the picture isn't all sunshine and rainbows. Like with any investment, there are always some potential bumps in the road, and there are a few things here that are definitely giving the skeptics pause. For example, for all that amazing yearly growth we just saw, if you zoom in on the first quarter of the new fiscal year, FY25, revenue actually dipped by 9%. Now, the company says this is because of some new SEBI rules, but hey, a dip is a dip, and it's something the bears are pointing at. And that's not all. There are two other big red flags for the bears. First, the company's cash flow is in the negative right now. And second, that premium valuation we just talked about, well, the bears don't see it as justified. They see it as simply too expensive and a pretty significant risk. All right, this next part is absolutely crucial to understand for any IPO. You have to ask, where is the money actually going? Is it a fresh issue to grow the company or an offer for sale for existing investors to cash out? We gotta follow the money. And wow, this chart really says it all, doesn't it? Just 16% of all the money being raised is a fresh issue, meaning that's the money that goes back into the company to fuel future growth. The other 84%, a huge chunk, is an offer for sale. So let's be super clear about what an offer for sale, or OFS, is. That huge 84% chunk of cash, it's not going into Grow's bank account to build new products or expand. Nope. It's going directly into the pockets of existing shareholders, the founders, the early investors who are cashing out. For the bears, this can be a major red flag because it might suggest that the insiders, the people who know the company best, think the fastest growth is already behind them. Okay, so we've heard the growth story, and we've heard the reasons for concern. Let's put it all together on the table so you can see the full picture and start to think about your own decision. So here it is, side by side. The bull case is all about that explosive growth, the fantastic profitability, and their market leadership, all of which, they say, justifies the high price. The bear case, on the other hand, points to that recent revenue dip, the negative cash flow, a valuation that just feels too high, and the big one, the fact that this is mostly just an exit for early investors. Look, we've laid out the arguments from both sides here. We've shown you the numbers, the narratives, the pros, and the cons. But at the end of the day, the decision to invest or to stay away, well, that's a personal choice that only you can make. And that, of course, leaves us all with the final big question.
With all this information on the table, the one thing only time will tell is just how much investors will actually grow with Groww.